Hey everyone, good afternoon. Thank you very much for joining me, Michael Manatskanian, for the next live underwriting and Q&A session for the Wealth the Real Estate School community. If you're finding us on YouTube, please make sure to reach out on Instagram, Michael MNAT, Michael M Nat, and our free school community is called Wealth the Real Estate. You'll find the link down below. So today what we're going to do is just talk about some quick things, just a few announcements, but the main focus of today is going to be underwriting a pad split property. So analyzing a deal that is a pad split property, and pad split is just a form of management, a rent by the room management strategy. Padsplit is basically the platform similar to like Airbnb for short-term rentals or Furnish Finder for midterm rentals. It's a platform to help you manage your rent by the room tenants, find tenants, lease it out on there, handle maintenance requests, all that good stuff. If you're interested in that, I have a link down below as well for you to get started. So we're going to underwrite this deal. I love the pad split exit, just as a heads up. I love our rent by the room properties at the highest level because they are typically bigger properties in nicer locations in bigger cities, which have a demand for rent by the room. So we're able to buy much better assets overall, and then typically end up with much higher returns as well, because we're really maximizing our cash flow, our income, by adding more income streams by renting it out per room rather than just the whole house. And it's much more cost effective and, in my opinion, easier to manage the mid to long-term rent by the room tenants than like a short-term rental where it's got new people coming in every few days, and you got to replace all these consumables and all that. And the furnishing is much easier. It's much more minimal than your typical, short-term rental or midterm rental. All right, so real quickly, I'm going to start screen sharing for you all, and we're going to run through this. Okay. Perfect. And I assume you can all see my screen. If anyone wants to give me a quick heads up. And if you want to join live, you have to be in the free school community. And then you could, get the link to join these sessions live rather than just looking at the recordings. Let me pop it up for anyone new that joins. Okay, let me get the chat going for y'all. Okay, so real quickly, this is my creative finance real estate investment calculator. It allows you to analyze both seller finance and subject to properties or loans, as well as the combination of the two. Just some updates for all those out there who have the paid version of the calculator. When you go on michaelmnat.com, you can go to shop and you can buy the paid Ultimate Creative Finance Real Estate Investing Calculator, which makes it really easy, manage tons of different exits and all that for a property. Or if you have the free one under resources, you have the Creative Finance Real Estate Investing Calculator. The main difference is that the free one stops as a long-term rental analysis tool. It doesn't do long-term analysis, doesn't consider if you're going to raise capital and use private money lenders, private money partners. It doesn't have these nice displays for if you are raising capital, how to raise it, how to present your information, very nice and easy. The long-term analysis, the private money partner and private money lender breakdowns, and then the various exits. So if you were to analyze this property over the long term as a pad split, rent by the room, midterm or short-term rental, or if you needed to quickly run a few scenarios to see if and when this deal would become a deal based on some, negotiating some of the terms, this also gives you that layout as well. So that this is the paid calculator on my website. There's a free one. Please enjoy it. It's got a lot of amazing features on it, but the paid one just has additional features. This one we're going to be working on. And the main updates, as I mentioned, is I just expanded a little bit on the other people's money. So one thing that we use for our private money partners now is we offer a preferred return. And a preferred return, very simply, is up until your lender gets this return on their investment, they will receive all of the income or the cash flow on the property until they receive that return. And then after they receive that return, at least the way that we do it, is then we split the remainder of the cash flow based on our ownership split. So this is very common in the multifamily space. We incorporate it into our our, single family or small multifamily properties as well, to make sure our lenders and partners are well taken care of. And just expanded a lot of this long-term analysis. The one big thing being that when you change the management strategy you're going to go with, instead of a long-term rental, you go pad split. Remember, this analysis up top is, well, actually, I'll run into that together, but it'll alternate all of the data for the long-term deal analysis. So, the long-term deal analysis. So if you were doing just a long-term rental, you see it's the yearly cash flow that's analyzed is 5282, and here's the return. So 9.9% cash on cash, 32% ROI. If you change this to pad split, it'll change all of this because it's going off of the information you provided here, adding that to the long-term analysis tab, and then bringing the results back to analyze what the property ownership looks like over the next 1, 5, 10, and 20 years. So that's one big feature, as well as just adding, when you're analyzing a property, sometimes you're analyzing it at the current rent or the rent that it, so this is actually market rent. So you're analyzing it as the market rent, what like the current rent is essentially, and then the pro forma rent, what you think you can get it to. So you can quickly determine, do you want to analyze it right here? You see 2,700 at its current rent and see what the returns look like, 440 or 9.9%. But once you take it over and put, let's say $3,000 or just a little bit of money into renovating it, you can get it up to the pro forma rent, and that'll show you what your returns look like there, as well as it's all done on the long term. So if you have this calculator or any of the calculators, you're always going to see a screen like this when you want to access it. So make sure you bookmark that. And here we have, all you're going to do is just click make a copy. And we're going to start with the underwriting of this deal. This, I believe, is let's see. So the first thing you want to do is organize it, right? So whenever you make a copy, you're going to go to move it and just move it wherever's relevant for you. So for me, we'll just say calculators for me, and then practice underwriting. So wherever you have it on yours, right? You're making a copy on your own Google Drive, and then you're just organizing it to where you want. And then I recommend changing the name. For me, I'm going to say Aaron Demo Pad Split. Actually, yeah. Split Demo Aaron. That's what I'm going to name it to. I like to name it the city, or whatever the property address is, all that good stuff. So let's just get into underwriting real quickly. Let's see what was provided. So this is a property in Fort Worth, Texas. I wish I could zoom in a little bit. Sorry about that. I can make all this bigger though. It's a little better, not much, but a little better. Okay, so it's a 4-bed, 3-bath currently at 2,400 square feet, built in 2004. Estimated property value is around 385 to 390,000. They're purchasing it subject to the existing loan at $365,000. The loan balance, so they're purchasing this property as a sub-2 deal. The loan balance is $353,295. I would assume the difference is going to the seller instead of it being financed, since I don't see anything about seller financing. So the difference between these two is going to get paid out to the seller. The interest rate on this loan is 6.25%, a 10-year balloon. So regardless of what the loan amount is in 10 years, the loan is going to have to be paid off. That's what the balloon is. There's an HOA of $39 a month. They say there are no rental restrictions. I personally don't like to deal with properties with HOAs. First and foremost, because the HOA fee never goes down, it always goes up. And secondarily, they can and might change these no restrictions to then allow for implement restrictions. Maybe they'll say no renting by the room because they feel like your property is a hassle, or no short-term or midterm or whatever rentals. So that's personally one reason why I think a HOA is a red flag. Doesn't mean I will outright say no, but just something to consider. Plan moving forward, so turning the 4-bedroom into 7. Okay, so just adding 3 more bedrooms. That could be feasible depending on the layout of the property at 2,400 square feet for a 7-bed, 3-bath. It's going to be tight, right? You're taking all your living rooms and all that out to make it happen. But the 3-bedroom or the 3 bath is nice because I like a ratio of bedrooms to bathroom, no more than 4 bedrooms to every 1 bathroom. So to have a 7-bed, 3 bath, that's solid. And the 4-bed, 1 bath is like on the highest end. You don't really want to go to that extreme, but understand that's kind of your rough limit, like 4-bed to 1 bath or 3-bed to 1 bath. This one is going to be 7-bed, 3 bath. So that's good. Roughly a 2-to-1. They already have the rental room rates. So I think these are the monthly rates that they have as opposed to the weekly rates, which is common for Padsplit. It's usually weekly payments. Gross income. So this is what they projected for gross income. PITI HOA, they say is 3170. So we can run with these numbers or we can try to recreate this loan. 750 for utilities and maintenance. That could be fine. Net income. So they've already done their own analysis. So let's start adding this information to the calculator. And actually what I'll do, you're going to see a messy desktop. I'm going to see my cute baby instead. Never mind. So we'll just go side by side so it's even easier. So because we're not going to analyze this as a long-term rental, we don't have to even add any information here. What we will need to do is add some information here. If you're doing a full long-term rental, you need to add your rent and your expenses. But your debt information is going to pull over from this portion of the calculator, the loan portion of the calculator. And then your taxes and insurance, you're going to manually input them. They don't have that broken down here, so we'll do some estimating. And then the other expenses, you're going to need the HOA. There's no mortgage insurance on this property mortgage insurance, which is the result of a low down payment option. That's typically the scenario in which you have to pay property mortgage insurance. Because it's a VA loan, that the VA loans don't have PMI, only FHA loans and conventional loans under I think 15 or 20% equity. Let's see. The utilities, we're going to put that all into the Padsplit section down here. We're going to break down all this information. So let's just start at the highest level right now. Let's start with the purchase and debt information. So we have the purchase price is listed as $365,000, $295,000. And then the sub-2 loan amount you're taking over, you have to enter that value here is $353,000, $295,000. So what we know is if this down payment is at 0%, that means there's $12,000 difference between the purchase price and the sub-2 loan. So that $12,000 is either financed to the seller or it's paid outright, paid to the seller so that there's no equity remaining on the deal. So otherwise you'd have to seller finance it. But in this instance, we know that there's 12,000. The assumption here, it's not stated, maybe it is stated. It's not stated anywhere necessarily. It's part of this total entry, right? This $12,000 is going to go as the down payment. So usually you just set it by the percent, but if you have a dollar amount, then you could put it, if you want to see what the percentage is, you can just write the code equals this 12,000 divided by or backslash just 365,295. That'll tell you it's approximately a 3% down payment of this purchase price is going to the seller directly. This $12,000 is then added directly into one of your entry costs here, down payment to seller. Let's continue on. So if there was seller finance equity, let's say this $12,000 was not paid out directly to your seller, but instead was seller financed and you're making payments over time, then you would add information regarding the interest rate and the term, like the length of time you'll be making payments to your seller. Because there is no value here, you can just disregard all this. You can set it to 0. Doesn't really matter. None of this matters anymore. That's why the monthly seller finance payment is $0 here. If you have, so now we need to get your monthly sub-2 payment. So the only way you're going to be able to do that is to either know what that monthly payment is, and they say, so PITI plus HOA is 3170. So I'm just writing that down, and they don't give us enough information to recreate the original loan. We could go up on PropStream and see if we can find information to help us determine what the original loan terms were. We can look on Zillow to get a rough idea, but based on, we do have the interest rate, so we can set that 6.25%. We can assume it was a 30-year loan because that's the most common, especially for VA. It's really 15 or 30 year, more often than not, it's 30 years. And the first payment date and the loan amount are necessary to recreate what the monthly loan payment is on this. We know the total principal and interest of the loan, plus taxes, plus insurance, plus HOA, in total is 3170. We can minus the HOA. So they said the HOA is right here, 39 a month. So it's going to equal that 3170 minus, we'll say minus the HOA amount here, and we'll set what that is. So here it is the 30. Here is the 39 per month. Okay, so there's 31 remaining. That is going towards the, so actually we could just put PITI. So what, not with the HOA, so just the PITI, right? The principal and interest payments on the loan, taxes and insurance. Okay, so if the current, just to give you a heads up, right? If the current loan amount you're taking over is $353,295, then the new loan or the original loan was higher than that amount. If, doesn't mean it's higher than the purchase price, but it does mean it's higher than the exact amount of loan you're taking over, as long as they've made a single payment on it. What I could quickly do is pull it up on PropStream. If you need a free trial to PropStream, just let me know. For those of you watching online, I'll make sure to include the link so you can get your free trial. This is what I use to do some quick analysis on properties. What happened here? Do some quick analysis on properties, as well as get information on the debt of the property. It's not 100% accurate, but it's better than any other tool that we have access to. And this will give you a pretty good idea. So let's see. So we know, see that either they refinanced or something, but they're saying the estimated interest rate is 4%. Loan amount is 358,050. Estimated loan balance is 350,129. That's kind of in line with this, so that's a good sign. Usually the loan amount, depending on the state, there's a few states that are non-disclosure states, so you'll never know what it was actually purchased for. But this property, it says loan, we have the loan amount, which is pretty good, and the loan due date, which is solid. So it says the loan would be paid off on April 30th, 2053, or we'll say, the final payment will be paid off May 1st, 2053. So if it's a 30-year loan, that means the first payment on this loan was May 1st, 2023. So 5/1/2023 is the loan start. And the original loan amount was 358,050. And then we'll add that to the calculator to recreate the loan and see how close we are. And it does say recording date was 4/10/2023. So because it was done in the first half of the month, more than likely the first payment was paid May 1st. Maybe it was paid June 1st. It's just one extra payment. It's not going to change everything substantially. You really just need the loan amount and the number of years to add. So let's see. So we're going to go here and we're going to recreate that original loan, because when you're buying a property subject to its existing loan, the loan is already established when the original buyer bought the property. All you're doing now is coming into the middle of this existing loan. We can't come into the middle of the existing loan without understanding the original loan terms. The best way to do that is to get a mortgage statement and then just to ask that information. In this instance, we don't have it, but it's okay because PropStream gave us a pretty good estimate. 358,050, 6.25% is what was. They're not going to lie about their interest rate to us, right? So if they say 6.25 and it's actually 4, they wouldn't do that. It makes their deal look even worse. And the first payment date was 5/1/2023. So this is a brand new loan. The issue here is if they tried to sell it conventionally, their debt is so high, unless they're able to get a substantially higher sale price than this $350,000 value, they would have to pay money at closing to sell the property. So they're better off getting the 10 or 12K from a creative finance or a buyer who will buy it subject to its existing loan. Because if they were to sell it traditionally, they would have to pay all these additional closing costs. And by the time everything's all said and done, they would have to pay money at closing, because I'm certain they tried to sell it conventionally and they weren't able to. And how do we know that? We can So you can get MLS data on Zillow as well. I think that's kind of the slowest piece. It's not that it's inaccurate, it's just a little delayed. So just going on here, so they were looking at 35, 4x3, 2,400 square feet. Let's see. So it looks like they bought it, yep, 4/11/2023. They listed it within a couple months at $399. This isn't because they flipped the property and renovated it or anything. Actually, it's a good sign too that this property for a long time listed for sale 385, 375, 350, 350, and then it went contingent and sold right around that amount. We know that the loan that was taken over was 358, so right around that amount. So when they listed it for 399, just a few months later, interest rates did not go down. They either stayed flat or even went up a little bit. Nothing has really caused this property to go up in value. They knew they needed to list it for a high enough price so that they wouldn't have to pay any money at closing. Once you account for closing costs and the loan that they have to pay off and all that, that wasn't going to be viable. So then they're opting to sell it creatively, and that's auditing the price history is really helpful for that. So let's get into it. We're really talking creative finance right now. We'll get into the Padsplit info shortly. Okay, so this says the loan payment is $2204.58. We're going to stick with that, and we're going to say, so the taxes and insurance, the difference between this 3131, right? We had the PITI plus HOA. We subtract away the $39 a month. Our PITI is the amount that's remaining is 3131. We just calculated the monthly loan payment is $2204.58. That's not your monthly mortgage payment. That's the portion of your mortgage payment that's going towards just the loans, principal, and interest. That's why you need all this information. So that means the remainder is this PITI minus your loan payment. So your taxes and insurance are $926. For the sake of time, we're not going to go into estimating what the taxes will be and all that. What I would do as part of my due diligence is to verify that the taxes that the seller is paying do not have any homestead exemptions or any veteran disability exemptions. So certain states, including Texas, have, just depending on the county that you're in, have exemptions or reductions in taxes, property taxes, paid by the owner if they're occupying it and or if they are a disabled veteran. So I would definitely check, and the VA loan makes me hesitant. I don't know exactly what, I don't want to estimate the tax what they should be, but what we'll say is $100 of that, it doesn't really matter. $100 of that goes towards insurance. And then the remainder of that, so this 926, so that means this is just taxes, right? We took away 100. We're gonna say it's 926 minus 100 is 826. And then we're just gonna set this 826 times 12 to know what the annual taxes are. Wow, 99.17. I don't know what taxes are in Texas. I know because they don't have an income tax, their property taxes are probably high. That's pretty high. I have $1 million property in California that is right around that amount. So, all right, let's take that 99.1709 and put it into our annual property taxes. And it could be that their insurance is higher. Maybe it's $200 a month, reducing this by 100. I don't know. I honestly don't really even care because at least for this round of analysis, we're just trying to see if this deal is viable at all. Then we'll worry about all the little details after the fact. All right, so, and they stated a 10-year balloon. Really important to note that this calculator is super powerful because it will tell you what your balloon is based off the loan that you are, the original loan. So if you bought it, so it's your first payment, this is 3/1/24. If your first payment, let's say it's the start of next month, so 8/1/2024. Although your loan balloon is 10 years from 8/1/2024, so 8/1/2034, the loan already started at some place already in May 1st, 2023, right? So the loan has its amortization or payment schedule already. You're just coming into the middle of it, right? That you see this white, your next payment, you're coming into the middle of an existing loan. You can't just start the 10-year balloon window at when the 10 years when the balloon start, when the loan started. You have to know, when do you take over? And then from 10 years from that date, what is the amount remaining? And that's exactly what this tells you. So if we go to the deal analysis, the balloon will say, based on the information you provided, the amount of principal you will pay down on that loan from the day that you took over from your first payment is roughly $62,000. And the interest you paid over that time is $205,000. That sucks. So you've made $266,000 in payments, but the majority goes to the principal of the loan. And that, if you understand amortization, every payment you're making is the same each month. However, the portion that's going towards interest is highest at the very beginning of the loan, and the portion going towards principal is lowest at the very beginning of the loan. As you continue to make each and every payment, the portion that's going towards principal increases, the portion that's going towards interest decreases. So the first several years are typically going the majority of interest, and that's really what this shows you is what we call the turning point. So at what point is the majority of your monthly payment going towards principal versus interest, right? And at this one, it's 4/1/2042 roughly. It's right where that cross section happens. So it'll take way over a decade, over half the life of this loan to just get to that point because the interest is so high. As your interest rate goes up, this pushes further and further away. As your interest rate is lower, it crosses paths much sooner. So let's now get into that. We have your balloon amount. So we know at the 10-year mark, you're going to owe your seller, you're going to need to pay off or refinance the sub 2 loan that you took over in 10 years. And the amount of that loan will be $289,688. Okay. So for you need to determine whatever your exit is in 10 years, are you going to be able to pay that off? I would say more than likely, even if you didn't increase the value of the property, just taking the balloon amount and the loan amount that you're taking over is roughly 80%, 82% is remaining on, like, the loan to value is 82%. So as long as the property increased just a few percentage, you're going to have the equity needed to refinance the loan and replace it with your seller. The fact that this interest rate isn't like a 2 or 3 or 4% is actually better for this balloon because interest rates could be around the same, maybe even lower. So the deal could get even better over that time period when you do refinance, or if you do refinance sooner, the deal could be even better, at 4 or 5% interest. But if this was really low, it'd suck to have to refinance out of a 2 or 3 or 4% interest rate when the market's much higher. All right, so now we have our sub 2 loan payment, right? We recreated it right here. We estimated from what was provided, the PITI plus HOA 3170, subtracted away the 39 for the HOA that we added as an expense here. Then we had our PITI, subtracted away our loan amount to get what our taxes and insurance are. And then this is just your tax estimate based off that. Why does it keep doing it? Tax, we got what that translates to annually, and then plug those numbers in. So we have our $100 a month for insurance, which is $1,200 a year, $826 a month for property tax, which is $9,917. Actually, we can even see quickly. See, it says property taxes are $4,140. However, this is year 2023 because they bought it in 2023. Their taxes wouldn't have been assessed till the future date. So I would check that. I would really dive deep into the taxes and insurance piece of it and verify, especially if there's any exemptions for the owner occupant. Like, I would really like to understand if you have a mortgage statement, right? What is going towards what? What is your mortgage statement will tell you exactly what is going towards principal and interest, and then what is going towards escrow. So I would very much look into that. I would get a copy of that mortgage statement if you don't already have one. All right, so now we have all of the debt information and the expenses accounted for. Now we're going to go into we're going to do the entry cost. So the entry cost is this $12,000. So let's see what they provide. $5,000 for wholesale fee. I don't know what this breakdown is. So $8,000 operator fee, $3,500 furnishing, $6,500 holding costs, renovations, wholesale fee. Okay. I don't know if this is the $29,000. No, because this is way more than $29,000. So it's $29,000 plus all this other stuff, potentially. Typically, the total entry is going to be the cash to the seller, any agent commissions, if there are any wholesaler fees, things like that. and then you do your closing costs separately, and it's up to you to analyze what other expenses there are. So this is like someone is asking for capital raising on this is what's happening, and they're telling you what the returns are. So that's fine. Let's analyze this as if this was a deal you'd want to buy, and then we can analyze it if there's an operator and you're the one lending on it, if it would be worthwhile for you. So the down payment to the seller is 12,000. There's still 17,000 more that needs to be accounted for. We're going to assume a portion of that is the agent commission. So it says 9,132 here. Even if it's 10,000 instead, that's fine. Just going to make the numbers easier for us. So 12 and 10, we need to get to 29,000. So equals 29,000 minus your down payment to the seller minus agent commissions. They say the rehab and furnishings, garage conversion, living and dining room. So we're going to save. This is really like your rehab and furnishings for a long-term rental. We're going to add that piece down here. So we'll save this piece. They say it's a $5,000 wholesale fee. So we're going to add to this, minus the 5,000, see how much is remaining still. They don't have admin or reimbursement. Well, they kind of do. That's their 8,000. And they're saying they're setting aside 6,500 for holding costs. So you're just overriding this, right? You're just going off someone else's information. For me, it's 3 months of monthly carrying costs, it's percentages of these things. They're just providing you this data in this instance. So they're saying the total entry is 2,900. There's $2,000 missing somewhere between the down payment to the seller, agent commission, and the assignment fee. So I'm going to just add it to the agent commission. We don't know where it is until you get more clarity on that from the wholesaler. So we accounted for the 29,000. The wholesaler or the partner, I don't know who's deciding that. We still need to do the renovations and closing, and we did the holding costs. Let's move this around for the sake of clarity. And then I'll show you kind of how I would underwrite this and look at this instead, because I'm not a huge fan of this right now. Okay. So we have the agent commission. We'll add the rehab and all that down below. We're gonna set this to 0 now because not for a long-term rental. They say, or we have closing costs at 2%. I don't know. It doesn't say who's paying what, just says that is the cost. 6,500 for holding cost. Okay. And that's it remaining here. All right, cool. So we have our entry costs, we have all of our debt info, and then we have our expenses associated with the sub-2 loan, taxes, insurance, and HOA. We don't need to worry about the utilities in this section or even the management and reserves in this section because we're not really underwriting this as a long-term rental. We're just going to go straight into the Padsplit exit. And so let's start adding that info. So the number of bedrooms added. So they're saying this property, so you want to definitely have the bedrooms and bath listed here because this is part of the equation overall, and I'll explain that shortly. So it's a 4-bed, 3-bath, and it's 2,400 square feet. And I don't care about the address. So you see here, well, we'll get into the analysis, but this won't provide you you will not have a calculation for the monthly income on a Padsplit unless the number of bedrooms here plus the number of bedrooms here equal the number of bedrooms here. So that is 4 bedrooms and 4 bedrooms. That's 8. Wait. And we're adding, they say 3. How many are we adding? I think it was 3 actually. So 6 and 1. So yeah, 3. Actually, coincidentally, it actually does work out now. It was better that it didn't, because what you're saying is there's currently 4 bedrooms. You're adding 3 more, so 7 total. And what this is doing is it's going to analyze your income based on the number of private bathrooms and shared bathrooms you have in this property. And you see even here it's listed that way because there's a huge financial difference for the income side between what is for units that have private bathrooms and for units that have shared bathrooms. It's a huge difference. Typically, this is pretty fair difference. So for our Atlanta properties, between 170 to 190 if you share a bathroom, 220 plus if it's a private bathroom. Usually you're gonna have a lot less of these private bathrooms than you do the shared bathrooms, right? Because, yeah. So let's get into it. So 3, and they say 6 are gonna have, so this is private. So 1 have the private, 6 are shared. And so now the analysis will work. We just need to plug in the right numbers. So we estimate $6,500 per bedroom to add, but that's such a wild estimation. It's just like for example, for them, for this deal that's provided, it's this property is they're going to convert a garage, right? Like typically what we're talking about is how can we add a few pieces, how can we frame in a few rooms, add some drywall to make it a bedroom, turn a living room into a bedroom, or a dining room into a bedroom, or a family room into a bedroom, like things like that. A garage is going to be more costly. So I would, you're going to underwrite it. This is fine to quickly underwrite, but you're going to want to get a contractor out there who knows what they're doing to get quotes to know really how much it's going to cost. But what we estimate is $6,500 a bedroom that you're adding. That's so per bedroom. That translates here to 19,500. But they did mention garage conversion, living room, and dining room. And look at that. Weirdly enough, we have the exact same renovation cost. Coincidence, right? I didn't know that, but that's where it is. I would say 6,500 is actually a little higher than what we usually see. But the perfect property is one that's got a nice flat roof. It's already situated in a corner where you're only adding 1 or 2 walls. You're just adding the door. Maybe it's got electrical outlets. Maybe you're adding 1 or 2 on each wall. Very simple stuff. That's usually what you want to do. That's like a good, easier conversion. They're doing a garage conversion. And then their furnishings that they're estimating is 3,500. I think that is wildly low. The cool thing and I don't know, maybe they're buying a short-term rental that's already furnished or something like that. When we do that, obviously there's much less furnishings to worry about. We love actually turning great short-term rentals and great markets into pad split properties because we're already buying it furnished. It's already been renovated. We know it's nice. It's just a different way to drive income to this property. Doesn't mean it's better or worse than a short-term rental, but it's a lower entry way of getting into a deal like that. However, a lot of those people typically have recently bought, interest rates were high. They put a large down payment down, so you have to navigate that element of it. Okay, so they say 3,500. The thing about furnishing pad splits is you furnish the common areas a little bit, right? The kitchen and all that kind of stuff, maybe some outdoor stuff. And then the bedrooms are very minimally furnished. You put your bed, and you have maybe a nightstand, some very basic furnishings. You're not going above and beyond on let's actually open up pad split. Oh, cool. So it's actually going to my hosting tool, which is great. So we're actually going to go to this market right now. We're going to go to Fort Worth. Too bad I know nothing about Texas. So, there's Fort Worth. Kind of. There's Dallas, there's Fort Worth. So what this is showing me is it's not one of their markets yet. However, there you go. Okay. So when you type in, it falls under the category of Dallas. So you can see here, the ones that are upcoming, you can get rid of them. And the ones that are live, you can look at them. And we're going to look at Fort Worth. And it's really zip code dependent. So I don't know where this house is, but I'm going to show you how you can pull up using the pad split tools. Whoops. How you can pull up the, so we're going to zoom out like when you're doing any type of standard rental comp. Okay, so it's over here. So closer to Dallas, further outside of Fort Worth. I don't know if that's better or worse, but it looks like it's in this area. Sorry, this is like my least skilled part is finding places on a map. So it's right here. There's nothing around there yet. Doesn't mean it's not upcoming. See, it's upcoming, but they're not going to have data on it yet. So just get rid of that and just go for the ones that are nearby. What this is telling me is, no, it's not. I don't want that there. Okay, so we're going to look and see what they say for the data here. So they say that right next to it, right? 14 units, 0 upcoming. So there's 14 currently. Average weekly is 198 per week, 270 to those with a private bath, 186 with a shared bath. What are they projecting? 825 and 1050. So they're telling you kind of the monthly, which is fine. Let's go ahead and translate those. So just to get a rough idea, they're telling you 825 and 1050, and there's roughly 4.3 weeks in a year, or the best way to do it is 52 week or 4.3 weeks in a month. The best way to do it is translate this to an annual. So if this is for the monthly, multiply by 12 to get your annual, and then take that and divide it by 52 to get your weekly rate. So they're saying 190 and 242 is what they're telling you. Padsplit's saying 186 and 270. So they're a little bit underselling what we're seeing in this zip code for so 76112. So I don't know what to put here. This is, I don't know, wholesalers info. They're going to say for this zip code, it's 76112. It has this at, let's change all these to dollar values. It has it at 270 and 186. I'd feel pretty confident with this 190. If they want to say 242 and it's 270, I mean, that does make sense that it should be less than, I would assume being further away from Fort Worth is, even though they're closer to Dallas, this far away, I would assume the further away you go this way, it's going to be a little bit less for the daily rate, because typically people are paying more in the major city centers, but it's also just dependent on that zip code and what's there. So it's 220 and 160. So it's much higher in the 76112 than it is in this one. So this is where having knowledge of that market is really helpful, and understanding how quickly properties get rented. So average occupancy 100%, that's a huge one. Average occupancy is 93%. So you might get more here, but it takes longer to fill up your property. The average occupancy per property, 11 days to your first booking versus this one where there's one and there's 18 units. So it's a decent sample size. And at 34 days to get to 80% occupancy. So around a month to get, 80% of your rooms rented, whereas it takes even longer. So you get your first one more quickly, takes even longer to fill up your 80%, and there's lower rates here than here. So it's really zip code dependent. That plays a huge role. We can look here because it's another neighboring market just to see what it looks like. 253 and 190, maybe because the airport, maybe it's a better area of town. I have no idea. But let's stick with their numbers for now, just for the sake of this, but you see how you can find it. Ideally, you have a property already in one of the markets, a proven market with at least 10 properties there, as opposed to you just guessing this stuff like we're kind of doing. We're going to reference this one, but I don't know anything about this area. It could be a much richer, nicer area than over here. We're not going to look into that today. There's not enough time. Okay. So they're fairly within reason, roughly. I mean, the 190 is fine. $4 a difference a week isn't going to change anything drastically. And the 242 being an underestimate is even better in this case. What I don't see anywhere is, hopefully they have reserves set aside, which I don't see, which is a terrible way to analyze a property without reserves accounted for. I'll tell you that right now. All right. So we're adding 3 bedrooms. We have the cost to build. I'm going to keep my furnishing costs and not theirs. I don't agree with theirs. Maybe it won't be 10,000 total to furnish. But it's, what do they have? 3,500 is, I mean, maybe they can do it. I don't know. Maybe they can do it at that amount. It's up to you to decide. That's underwriting is very personal, right? There's rules and whatever, or not even rules, there's guidelines. It's up to you intentionally how you will do it. Or like, it's up to you, you plug in the numbers, you have to feel confident with it, however you proceed. So if you want to underwrite at 3,500 and you feel confident, go for it. I estimate around 1,500 per room, but really part of that 10,500 isn't just to furnish a room. A room's gonna be less than 1,500, probably closer to 500 to 1,000. It's also sharing the cost between the rooms for the level of furnishing in other areas. All right, so the total new entry cost, right? It's gonna take this entry cost you have listed here, and then it's gonna add your new cost to build the rooms and your furnishing costs, and that's your total new entry cost, $80,000. So they say 71,500, the main difference being the couple grand that went to furnishing costs and let's see what else is different. Oh, and they didn't have your closing costs. So I don't know why they wouldn't account for closing costs. So actual entry 80,000 when you account for closing costs. Okay. So we actually end up once again right at the same number, but they're estimating closing costs to be much higher. Maybe the buyer is covering all the closing costs. That's information that wasn't provided. But whatever, we're at the same one roughly. So that's actually pretty interesting. So now you add your weekly rates. We already added the number of rooms. We're going to add the weekly rates here, which we said they went with 190 and 242. Oops, I flipped that around. So 242 for the private, 190 for the, so you need both the number of rooms to equal the number of rooms up above. You need, and then you need to add this information. Otherwise it just won't calculate. And I've set it as an error code instead. So it'll just destroy everything if those numbers don't line up. So unless those numbers line up, these two bedroom counts equal this bedroom plus this bedroom count, it will not calculate because you can't actually estimate the income that way. And you really need to, like, it's one thing to analyze a property. And I added this on behalf of feedback. It's one thing to analyze a property based on the weekly rate, but it's disingenuous if you're not separating between private bathrooms and shared bathrooms. It's just not accurate. All right. So our Padsplit monthly income, $59.89. They have closer to 6,000. So we're not too far off, right? $11. They're subtracting away your PITI and HOA. So we have that same 3,170. They have 750 for utilities and maintenance. I have roughly 600. This is a total estimate, right? Just gonna depend on your property size, number of guests, what services you're providing, what the location is, on what the costs are. There's just a rough estimate at 600. They say 750. They say and maintenance. So I wonder if that includes their reserves. I would say they're not accounting for Padsplit costs. The actual platform itself, it looks like they're going to self-manage it, as a matter of fact, because of the fact that they're not accounting for it. And they're talking about the monthly rate. Typically, if they were going to use the Padsplit platform, they would talk about a weekly rate. That's more common. I think their plan is to self-manage. I would still analyze it with property management involved, because at some point you're not going to want to manage that property yourself. You're going to need to know, how will this property perform after the fact? And Padsplit themselves takes the first 10 days, at least currently, the first 10 days of each new tenant's total income. They take 100% of income for the first 10 days. And then they take 10% of the income moving forward per tenant. And then the remainder is like to pay someone else the remainder of the fee to like place tenants and all that. Padsplit just a listing platform like Airbnb. You still have to do the management, actually, like the actual management of it. Yeah. Vacancy. So there's 8%. This is roughly translating to 1 month a year. In this instance, it's saying each of these bedrooms will be vacant for 1 month of the year. It could be less, it could be higher. We're seeing that 80% on Padsplit in these areas. Average occupancy is 93%. That roughly translates to that, having 8% vacancy, right? Because your occupancy, if your goal is 100% occupancy, that minus your vacancy is what your occupancy is. So 100 minus 8 is 92%. We're pretty much in line with what we're seeing here. I'll say this zip code, right, we said was 100%. Average occupancy. This one's 85%. But what we analyze with, at least initially, is at that 8% amount. So I would account for that. I would account for money set aside each month for maintenance or capital expenditures. Even if you don't need it, amazing. You have property, you have reserves set aside for the property. If you do need it, well, the money needs to come from somewhere. It should be coming from the returns the property is generating. You're setting aside reserves. That's then deployed when necessary, rather than you having to come in and bring more money. So my total expenses are significantly higher than theirs because we're accounting for property management, vacancy, and maintenance and CapEx. They say it's really just 750 in utilities. They're not counting for anything else. We could set all these to zero just the way that they are. And we're seeing this property is generating $2,000 a month in income. They're splitting between two partners, and the cash on cash return for the total investment is 30.7%. However, it's easy to say that if you're just omitting all of your reserves, management costs, all that stuff. I would never do that. I don't, if I'm self-managing it, even if it's in a great location, even San Diego, I'll still put at least 3% vacancy because the property has some turnover. And even though there's a brand new house, like I would actually give this concessions. I'd say maybe only 5% for maintenance and CapEx. Over the long term, you'll build up enough reserves to replace the roof and all that, but everything is fairly new. Well, actually, no, it's 2004. It's not even that new. It's actually, unless they just put in a new roof, it's basically time for a new roof. So never mind. I wouldn't, I would keep it at 10%. Vacancy, if you're going to assume it's 100% occupied, there's no property management fees, like that's fine for you if you want to go that route. I would personally not do that. Let's just go with their numbers for the time being, for the sake of this analysis. What they're looking for now is a private money partner who is going to the best of my understanding, going to fund the total entry, right? The total entry costs. And this will be their cash on cash return, and they will sell the property in 5 years. One thing to consider is now you've taken an actual house that the majority of people want to buy, and you've turned it into this Frankenstein home that maximizes bedrooms for rent, but like you're limiting massively the buyer pool. Your next buyer is going to be someone who's an investor. So it's limiting the number of people that'll buy it. And typically investors are not the ones to overpay for properties. They buy them at or below market value, typically not above market value. So you're going to get a much lower sale price than you would if it was set up as a traditional home. Either you're going to have to break down those new walls you added to make it more functional, like add back the living room and all that, or you're gonna have to sell it to another investor. Maybe you creatively sell it, whatever. It's up to you, but just understand that you're taking a house that people will pay money for to live in and turning it into a straight investment property that either needs to be modified again to make it a house for someone to buy and live in, or sell to another investor, which is limiting your buyer pool. So objectively, with no reserves accounted for, this is a good deal. With reserves accounted for, it's a great deal. 30% cash on cash, $2,000 a month of cash flow. With reserves accounted for, this quickly goes into basically generating no cash flow and very minimal return on the 80+ thousand you just invested in this deal. Once again, let's go through their numbers. Maybe they have a rationale for it. I don't know. Maybe they will, as the partner, they will operate the entire property and they will not charge anything for the management. There's still vacancy and maintenance and CapEx to account for, but even if you remove this, now you're looking at less than $1,000 a month and less than 15% cash on cash return. So, that's for you guys to figure out what's actually going to work. I account for these reserves even when I'm managing a property. So when I'm raising capital for a property, I'm accounting for all of this information already. So it's even more like, even if we are self-managing or we don't need to use as much maintenance or CapEx, or there is less than anticipated vacancy, cool. That means we are making more money, but I'm not jeopardizing our initial investment based on really, really perfect scenario of management, because it usually never doesn't work that way. So now let's get into the private money partnership tab. So this is, if you come in as a private money partner, how will this look? Let me just minimize it. Let me just get rid of all this for now. So for the 1 and 5 year, okay. So because we set the entry cost here is 50,806, because we set the management strategy to Padsplit, all the information is Padsplit information. So when you go here, the entry cost that is provided by the partner is, let's see, all the information provided by the partner, or all the entry costs are covered by the partner, which is typical. Maybe you're going to decide that they cover 50%, you cover 50%, whatever. You can change those values here and it will change everything else. So let's say you go that route. So it's 80,806. You're going to say equals 0.5. So 50% times 80,806. Well, you still, actually, you could just do this. You could say equals 0.5 times this. Oh, actually, that's right. That's why I hard coded this, which is awesome. So this is the total entry pulled from the other slide, the total entry costs. What you're gonna do now is just set, okay, you're gonna cover 40,400 or 40,400. You're gonna cover that, your partner's gonna cover the remainder, right? And then all the numbers are analyzed that way. And let's say you then want to do in this instance, let's analyze the way I do, and then I can show you that after. So $80,806, and that's what your partners bring into this deal. The private money partner, they're funding the deal for ownership in the property. In this instance, they're getting 30% ownership, 30% cash flow, and a 5% preferred return. Nothing was mentioned about preferred return, and it seems like they're splitting everything 50-50. So let's set the preferred return to 0. Perfect. We're going to set the ownership to 50% and the cash flow to 50%. So let's see, deal analysis calculator C49. I just made the changes, so there might be a little bit. AD8 and long-term analysis. Let's see why the cash flow is wrong. 29,745, and that's going to go off of 08, which is this times 12, so C8 minus E8. C8, so your income. Why are your utilities and fees so high? Your income minus your taxes minus your insurance minus utilities and fees. Property management, vacancy, reserves, and the loan payment. What the hell's going on? Oh, you know what? When I changed the code, I might have changed this one a little bit, unfortunately. So I'm going to just hard code this for the time being and I'll fix it. Utility and fees and for Padsplit are going to be some just these two values. There you go. And then everything else is fixed based off that. Okay, there you go. So this is right. I'll fix it on the actual one after. So this is showing $8,763 of cash flow. And then it's split 50-50 between the partners because there's no preferred return, right? If there was a preferred return of, let's say, 5%, the first $4,040 are going to go towards the private money partner, and the remainder is split, in this instance, 50-50 between the partners. There is no preferred return, so that's 0%. There's no money getting paid out for return. The total cash flow is being split between the partners. Then there's all the other ownership benefits, you know, it's going to appreciate and all that. What I'm seeing here is if you split 50, if you're the partner who comes in with $80,806, you're getting 50% ownership, 50% cash flow, your cash on cash return is 5.4%. So your annual cash flow divided by your entry cost is 5.4%. Your total return on investment is 21.5%, right? And over a 5-year period, it's 33.8 and 117.4%. Just to put into perspective, right? We are accounting for the full reserves in this instance, so that's good. I'm actually not too certain these values are now accurate in here either. Vacancy, C8. Oh yeah, we didn't account for a management fee is what we did. Yeah, so I have to go fix some of this stuff, unfortunately, but it's okay. It's just easy fix. So when you account, now it's actually way worse. Now that you account for all that, when you account for management, right? We set it at 0. When you account for management, this property makes no freaking sense. Right? It's making literally like no money. Yeah, because I don't want to fix this right now. It's making virtually no money when you account for all the reserves. If you were to change this to 0, yes, you can say the partner is going to self-manage it. That's getting them their 50% plus finding the deal and managing it. So this 991 is now split, but they're saying there is no vacancy. There is no maintenance and CapEx. Let me make sure these are transferring over, which is great. Saying there is no maintenance and CapEx, no vacancy, none of that. Then they're saying, oh, actually, so the returns are 2,000 and 30% cash on cash. You as the partner are getting 15% of that and 31.7%. So yes, they're saying that that's the returns, it's up to you. Are you fine with accepting that? If there's no management set aside and someone has to do the management, Padsplit itself, they're using that platform, takes over 10% of your monthly income. Is you have no reserve set aside each and every month for your property. So when things come up, someone's gonna have to pay for that out of pocket. And there's no vacancy account for. So unless your property is running at 100% rented all the time, the numbers are already artificially inflated. So just to give you perspective, when I'm analyzing a deal and raising capital on it, I do not buy a property that is not generating at least 7% cash on cash return, or between 6 to 8% cash on cash return for my partners and over 20% return on investment. Okay. That's after all of these are accounted for. So if I'm going with a pad split exit, I have the 8% vacancy and I have the 10% for reserves. I won't even look at a deal if it's not already generating these goals with all these accounted for. So $1,000 a month of cash flow after all our reserves are accounted for, and 15% cash on cash return after all our reserves are accounted for. And then my partners should be getting at least 6%, if not higher, cash on cash return, and able to pay them a 5% preferred return. And their total return on investment is 20+%. Okay. Just to put into perspective, I personally would never do this deal as a buyer or a lender. As a buyer, right? $92 a month of cash flow and 1.4% cash on cash return. That ain't doing it for me. I'm not going to put $81,000 of my own money to make $92 a month. Yes, there's reserves and all that, but I'm not gonna artificially inflate my returns to assume, oh, I don't need to set aside vacancy reserves, pay a property manager. Maybe someone else will. I don't, it's up to you guys. And the cash return at 1.4%. Those don't hit my metrics. I won't even look at a deal like that, let alone lend on a deal that just doesn't even work. All right. I can do questions for a few minutes. I can go over any of this with anyone, and then I will go and fix this calculator a little bit, as I just made a bunch of changes right before this. So with all that being said, questions. Aaron, you got anything for me?
No, I don't. Thank you very much for doing the deep dive on that.
Right. And this was more actually just analyzing the terms provided, right? Like we didn't go and find everything necessarily. We did analyze the pad split rental income because that's kind of the nuance. There's 10 plus 50, no, maybe not 50, but a dozen plus of me going through seller finance, subject to, finding insurance, taxes, all that stuff in general. I really wanted to focus on analyzing this pad split deal on this calculator if you already have all the information. But we also just took a little bit of extra time and went into how to like verify the rental income using the pad split
Right.
tool available. Even if you don't do a pad split tool, it's still very important.
Yeah, cool. Thank you very much.
Yeah, cool. Anyone else have any questions? Otherwise, I'm going to ask you all to do me a favor. I've not asked for a lot. If you all can screenshot, share on your social medias, Michael MNAT, I appreciate it. If you're not already following me on social media, please do so. I'd greatly appreciate it. If you're watching this on YouTube, like and subscribe, all that good stuff. And if you want to be part of these live underwriting and Q&A sessions, just you got to join the free school community to get the link for that. So please do so. Any questions from anyone else who's here live?
Yeah, Michael, it's Gary. To get the updated spreadsheet.
Right. So you have the link. The link was emailed to you, right?
Okay,
And then all you do is you click that link. I would bookmark that link.
got it.
And every time I make updates, it's always updating that one link.
Perfect. Thank
Based
you.
on what we just saw, there's a few areas of code that are broken. Give me 20 minutes to fix it, and then we should be good to go.
Thank you.
Okay. Thankfully, I'm really good at Excel, so it won't take too long. Well, you got a taste of that yesterday during our meeting. Anything else for anyone? Any questions about anything?
Hi, Michael. I've got a question. First of all, thanks for doing this. This is great. The recordings, are those also on school? Do you have recordings available?
Yeah, so let me show you. Let's go through that real quickly because I feel like this gets asked and I want to make sure you all know how to do this. Let me open up school real fast and then I'll start with screen sharing. And I know your view is a little bit different than mine, but okay. So let's do share. Okay, can you see my school? You see it? So this is
Yes.
the Wealth of Real Estate school community. We have just over 200 members. And we barely even started marketing it to anyone. So it's awesome that there's over 200 like-minded people who are trying to generate wealth of real estate, and they're allowing me to help them on that process. Sorry, just added one more. We're at 205. All right. So when there are these live recordings, they get added to the classroom. However, the way school works, which is great, which is why I incentivize engagement, is there's leaderboards. And the more that you do, the higher your engagement, you unlock more things. For me, every month, I give you all cool prizes. I give you access to the paid calculator, to the paid community, to PropStream tools, to whatever, that kind of stuff. But also, as you engage with each other more and more, you start unlocking different trainings. So for example, a lot of people are stuck at this rookie, and that's maybe because they're not engaging enough. Not my problem. They got to engage, right? You got to engage, or you're newer or whatever. The more you engage, right? Everyone has to start here. The more you engage, the more you unlock. So we have a whole series on traditional real estate investing. We have a whole series on creative finance real estate investing. And then we have the live underwriting recordings, which get added here. So you'll get access to that. I will give you full disclosure. I also have a lot of these on YouTube already. You can go follow me on YouTube and watch it on there. But if you want it all nice and consolidated and coordinated, it'll be here and you'll unlock it through engagement. Hopefully that added clarity.
Absolutely. Thank you.
Awesome. Of course. And then I probably will do a little pay to play thing at some point where someone just wants to pay a certain amount that can unlock all the trainings. I don't know. I have no specific plans for that, but if someone just says, screw it, I don't want to engage, I'd rather just pay to get it, I'll probably do something like that. I just don't know yet, nothing like that in the works. Yeah, so that's it. So engage, post your intro if you haven't already. Make sure to post your intro and say hi to people, engage with other people's intros, all that good stuff. Cool.
Awesome. Thank you.
Of course. Any more questions? I uniquely
Thanks,
have.
Michael. Appreciate it.
Yeah, of course, Aaron. Hopefully that was helpful for you.
Totally.
And now the cool part is you're gonna be able to do it on all the other Padsplit deals, whether you're a buyer or a lender, right? We went into that quickly, the buyer or the lender. But the reason for that is, as a lender, you should still analyze the deal as if you're the buyer. And then you just see, okay, well, now we're going to split, right? Either I'm a private money lender. Do they have enough cash flow to pay me each month as a private money lender or as a private money partner? Is the property going to get the returns that is needed so that when it's split, the cash flow and ownership, am I going to get the returns that I need to invest the money in this deal? So everything is still the deal itself. And then you just extrapolate, or then you expand. Okay, if you're using a private money lender, private money partner, or you are the private money lender, private money partner, you're just looking at, that info. And once again, the calculator is listed on my website. You get the free calculator. It's also listed in school. Oh, I don't think I'm sharing anymore, but it's listed in school. And then it's also listed on my website, whether you want the paid one, the free one, or consultations, like some of you in here have done as well. So thanks all. Have a great rest of your day. Appreciate you being here.
You too.